All right. Happy Friday, everybody. Good afternoon, all you magnificent melon heads of the world, and happy Friday, everybody. It's August 16th, 2024, and it is time for my favorite part of the week, my weekly wrap-up live stream. And what a wonderful way to wrap up the week, but with gold at an all-time high. Yay, gold. Hooray, hooray, and cut it. All right, gold at an all-time high, $2,500 an ounce. Big, beautiful number. Amazing. So what's going on? Why is gold rallying? What is taking the price of gold higher? And this is a serious question. Why is gold rallying? You don't need to pick one. I got a million different reasons gold could be rallying here. We're going to posit a few of those today. We're going to take a look at a couple of the charts, a couple of stories going on, see why is gold rallying right now? Because, guys, gold is a safe haven asset. Gold is where people run for shelter during uncertain times. Gold is a hedge against inflation. Gold is not where you go to make big gains. Gold is where you go to avoid losing everything. So why is gold rallying here? It's the best economy ever. Remember, the gaslighting financial press told us so, that everything was so good. So let's see, what could be taking gold higher right now? Maybe it's the weaker dollar. DXY, the US dollar index, down again this week. A couple weeks in a row, down big, 102 and change. Maybe that's putting upward pressure on the dollar. Maybe it's lower interest rates. 10-year treasury yield is down again. Maybe that's why. Although yesterday the 10-year treasury was rocketing higher on the news of that slightly better than expected. Well, no, it was better than expected, the retail numbers, although most of it was autos. But maybe it's lower interest rates are taking us lower, taking gold higher. All right. And also, maybe interest rates should be higher right now than they really are. So just a thought, but there's two big things going on right now that are suppressing interest rates on the long end of the curve. The first is the Treasury's buyback program. Remember, Treasuries raised their buyback. They doubled the amount of it just a few weeks ago to up to, I think, $30 billion. Was it a month or a quarter that they said they were going to buy back Treasuries? They're actually selling more short-term debt and then taking the proceeds of selling that debt and using it to buy back long-term debt. But with the yield curve inverted, that's actually more expensive because the interest rate on the long-term debt that they're retiring is lower than the short-term debt. Why would they do that? They're driving themselves further insolvent. Oh, that's right. It's an election year, and we can't have higher interest rates on the long end of the yield curve doing things like causing higher unemployment, which is coming anyway. So the Treasury is doing a buyback. That's what happens when you get a central banker running your Treasury department. Or maybe it's the fact that the Fed, even though they've been telling us they've been tightening, you remember all the rhetoric about, the most aggressive tightening cycle in history from the Federal Reserve? What if I told you the Fed has actually been easing where it counts? Shout out to my buddy Joe Brown over at Heresy Financial, who pointed that out in an interview a couple of weeks ago on this channel. The Fed has actually been a net buyer of long-term debt on the yield curve. They've been buying 10, 20, and 30-year bonds. They've been buying more of those, even as they've been reducing the holdings of their balance sheet. They've been selling more of the long or shorter dated stuff like the T-bills, selling a whole bunch of that, but actually buying more of the long-term stuff, bidding up the price, bidding down the interest rate. Again, the Fed is artificially creating more liquidity on the long end of the yield curve. And maybe that's why the U.S. Financial Conditions Index is still in negative territory. If you look at financial conditions, the overall state of liquidity in the bond market, we're actually looser now than we've been since February of 2022, before the first rate cut ever even happened. All this noise about the Fed was too aggressive and they tightened too much. They did not tighten at all. Financial conditions never even drifted close to restrictive territory as measured by the Financial Conditions Index. So maybe that's contributing to why gold price is rocketing higher here. Or maybe it's the fact that presidential politics has devolved into an everybody gets a pony contest. Free shit paid for by the people whose votes we're buying, who don't even realize they're being robbed to pay for their votes. Financial illiteracy for 500, Alex. That's right. I mean, Kamala with her plan, her big plans today, and Trump with his big plans. You know what they're both doing? They're both just buying votes right now. And of course, vote buying is terrible for the voter who doesn't even realize it, because we don't teach economics in this country. Something I'm trying to fix with this channel. I hope we're making a little bit of a dent in that financial illiteracy here at this channel. Humor me. Humor me a little bit in the comments. Tell me I'm helping. Tell me I'm making a dent. Nobody's telling me I'm helping. Oh, no, it's not making a dent. Well, look, it's the everybody gets a pony generation, and the government is trying to buy your votes with your own money. Explain to me how that works. I don't know, but it just does. Kamala is out there talking about today how she's going to forgive medical debt. Oh, that's a good one. Wait a minute. Didn't your side, didn't you make healthcare affordable 15 years ago? I seem to remember a thing 15 years ago about affordable care. And why are we even talking about forgiving healthcare debt if we already made healthcare affordable? And then in the next breath, she's like, we're going to make housing affordable too. And I'm like, shit, stop it, please. Don't make anything more affordable. Whatever you do, we're all good here. I can't afford any more of your concept of affordability. Please stop. So maybe that's why gold is going higher, because vote buying has become mainstream. Or maybe it's the fact that central banks have shown us just how spineless they are. The Bank of Japan is already backing off of their rate hikes. I'm hearing the Bank of Japan might hike one more time by March of next year. One more rate hike. They raised rates from nothing to 0.25%, and the whole world freaked out. Carry trade was unwinding and all that Black Monday mumbo jumbo. Remember that? Godzilla in the thumbnail? I know you guys remember that one. And it didn't even last a day. The Bank of Japan has already started to walk back. The Prime Minister, Kishida, he's out in Japan. Presidential politics has been thrown into a tailspin over in Japan. They're already backtracking. The point is, the central banks cannot unwind this easy money policy. They've tried, pathetically so, a measly 25 basis points of rate hikes in Japan, and their stock market had the worst day in history. It almost caused a global collapse, and they're already backing off. So maybe gold is rallying because they realize all this talk of tightening is BS, and they know the Zerp and Burr is coming back. Or maybe it's safe haven demand. Maybe everybody's worried about a recession, because Japan almost collapsed. If Japan actually does unwind the carry trade, their economy will collapse. You'll see deflation in Japan. You'll see massive economic contraction. Well, that's the world's fourth largest economy? Germany, the world's third largest economy. They're already in a recession, doing a great job over there, by the way, you Greens managing energy policy in Germany as your entire continent deindustrializes and goes back in time 100 years while telling yourselves you're modernizing. Congratulations, keep up the bad work over in Germany. So that's the world's third largest economy. They're in a recession. What about China, the world's second largest economy? They're fighting a deflation problem over in China. They are in utter collapse over there. Now, I know there's a lot of people every day are out here trying to call a bottom in China, but the data just keeps getting worse and worse and worse in China every day. And it's not just the housing sector. It's not just Evergrande and the developers anymore. It's spreading to the consumer sector. We're hearing stories this morning about convertible bonds for automakers going into default, so it's spreading to the discretionary categories now. Well, the world's second largest economy is in a tailspin. I mean, they're not saying they're in a recession because all the statistics over there are government manipulated. But trust me, China is in a deep recession. That's the world's second largest economy. And, well, the U.S., unemployment at 4.3%, triggering the Sahm roll, even though Claudia Sahm is a clown and a political hack who blocks anybody who dares to question her because she traded her academic credibility in exchange for a hope of a position in the Biden administration that might one day result in speaking fees. But besides all that, yeah, the U.S., we're entering a recession as well. So maybe people are rallying and buying up gold because the world's fourth, third, second, and largest economies are all either in a recession or going into one. The point is, guys, there's a million different reasons why gold could be rallying right now. It's long overdue. Just be glad you own some. And I'm guessing if you're watching this channel, you own at least a little bit of gold. So congratulations. Enjoy it, guys. Another all-time high in gold. And I know my silver buddies, oh, you guys, I know you're out there. Silver's sitting this one out again, guys. I mean, it's getting in on the rally today. We're back above that all-important 2830-ish level. All right, so silver is rallying big today, but still nowhere near an all-time high, not even anywhere near the high of the year. Silver still can't catch a break. I believe it is that industrial element in silver that is holding it back. And look, I have been as bullish silver as anybody else that's out there, But I have been warning, all these silver bulls have been saying, oh, the solar panel demand and the electric vehicle demand, it's going to lead to all this industrial silver consumption. No, it will not, because electric vehicles are stupid for 80% of the world. If you live in a city and almost never drive, an EV makes sense. For pretty much everybody else, it doesn't. The market is starting to figure that out. And solar panels don't work half the time. It's called night. Look it up. I'm pretty sure it's going to happen again in a few hours here. And them solar panels don't make any power when the sun goes down. I cannot believe I am still trying to explain this after all this time. So if you really think there's going to be all this new sudden surge of demand because the whole world's going to electrify and solar panels are going to be everywhere, guys, it's not happening. I've been hearing about it for years and it still ain't happening. The industrial demand is a drag on silver right now. We're going to look at some industrial indexes that came out yesterday as additional proof of that. But let's not get down on silver. Let's just celebrate the gold. And let's shrink my big melon of a head and see what's going on in the market today. And it is one heck of a day. The S&P is rallying again. It's up a little bit, 11 points, 0.2% higher. But you know what? The S&P started the day deep in the red. So all things considered, it's doing pretty well. And look at this long-term chart of the S&P. Now, guys, do you remember during the sell-off? Do you remember during the sell-off as we were watching this happen? Remember, I kept saying, guys, this looks an awful lot like that sell-off in April. You guys remember how that sell-off in April ended? Oh, that's right, with stocks just grinding higher, and that we still have NVIDIA earnings to get through here in about another, 10, 12 days out? Well, look at what has already happened. The S&P reclaimed its 50-day moving average this week. It looks like it was a repeat of April after all. Look, there's a million reasons in the world why the stock market should go down, but as long as financial conditions are easing and liquidity is being added to the system, which it is, markets are going to keep going higher. Those risk assets are going to keep getting bid up. And the Dow is also up today, 122 points, 0.3% higher for the Dow. You know what? I'm looking at the freaking futures here. Jesus, I didn't even update the charts. Son of a gun. I am remiss. Let's not look at the futures. Let's look at the actual index, shall we? I got to reset my chart. Sorry, guys. I'm a little behind the eight ball here. All right, the Dow, 40,682, up another 120 points or 0.3%. So that was accurate at least. Long-term chart of the Dow, again, pretty much the same thing, guys, although not quite as pronounced. This sell-off, it ended up being pretty much just a repeat of the April sell-off here. Actually, it was a little bit of a kind of like a little double dip sell-off there that we had in May and April, and we kind of had the same thing going on here, but the Dow is back above its 50-day moving average, 40,000 plus, and grinding higher. And the NASDAQ, I also did not update the NASDAQ chart. It's still sitting on the futures from this morning. Apologies for that one. And we got to wait for the stupid ads. Yeah, Jack, get an ad blocker. I know it makes me disable it. NASDAQ is up 39 points, 0.22% higher, 17,633 on the NASDAQ. And once again, on the long-term charts, NASDAQ looking like it's going to be close, but fighting for that 50-day moving average. Once again, we talked about that sell-off, and we said, beware, it's looking a little bit like April. April ended this way, and then we've got this. The NASDAQ came right down, bounced off that 200-day moving average, and now threatening the 50, threatening to grind even higher. And again, those NVIDIA earnings, as far as the NASDAQ is concerned, it's the single biggest data point in the whole freaking index. And right now, it's looking like NVIDIA's earnings are going to be incredible once again, and never underestimate what this market will pay for things. And people are starting to ask questions. What is actually supporting this AI bubble? Newsflash, nothing is. But you know what? That doesn't stop retail from FOMOing into these AI stocks and these chip maker stocks. So right now, it looks like this market is going to grind higher after NVIDIA earnings, unless people suddenly wake up and start listening to me, which I really doubt they're going to do. Also, we got the Dixie is sharply lower today. This is probably a big driver of this surge in gold, down 49 basis points to 102.48. Weaker dollar, that's putting upward pressure on asset prices. So definitely contributing to some higher gold prices there. And bond yields are largely lower with the exception of the 1 month. The 30-year treasuries at 4.153, down almost 3 points. The 10-year, 3.904, down 3 points. The 2 years at 4.064, down 3 points and change, almost 4 points. And the 1 month is actually up a few ticks, 5.361. The 10-2 inversion is now 16 basis points. So again, the 10-2 inversion keeps getting bigger here, guys. The yield curve is re-inverting. And I use that term loosely because the yield curve never uninverted. And looking at the commodity space, there it is, guys. Look at that big, beautiful 25 handle on spot gold, $2,504.73 for the price of gold, up 48 bucks today, almost 2% higher for spot gold. December gold futures trading even better than that, 25.42 for those December futures. Fantastic day for gold here. Silver's getting in on the price action today too, 28.92 for spot silver. That's up 57 cents, 2% higher for silver. I like the shiny. Copper, meanwhile, is up just a fraction of a penny here at 4.15 for September copper futures. Let's see, platinum futures down 1/3%. Palladium futures up 1/3%. And WTI crude oil is down 1.75% here at $76.78. That's some of that global recession fears there. And before we get into gold, let's also do a pit stop at Bitcoin. Bitcoin is up nicely here, $2,200 an ounce higher for Bitcoin on Coinbase, but still below that all-important 60,000 level, trading at 59,792, also still below the 50-day moving average. And that is your trip through the markets, and I just want to say thank you so much. By the way, Mr. Watari, I saw you before we went live, but for whatever reason, it's not showing up in the comments here. Where are you, Jim Watari? There was a couple, man. Where did it go? I got to scroll way, way up here. Son of a gun. Anyways, Mr. Watari, thank you for gifting those Nobody Special Finance memberships that I cannot find right now because you guys are going crazy in the comments. There we are. Thank you so much, Jim Watari, for gifting 5 Nobody Special Finance memberships. I appreciate that very much, sir. It was before we even went live. And guys, don't forget to give Jim a thank you if you receive one of those memberships. Thank you, Jim, for supporting the channel. I appreciate that very much. And who else we got here? We've got Grandpa is also there. Said NFCI, or National Financial Conditions Index, has been plummeting since the March 2023 banking crisis. Funny you should mention that time there, Grandpa. Remember we were talking about spineless central banks? The Bank Term Funding Program. It's not a coincidence that financial conditions have been loosening since that bank crisis because the Fed eased financial conditions by creating this new liquidity injecting mechanism. They didn't call it money printing. They called it something else. Net effect was an increase in liquidity. I don't know how that's not money printing, but people out there that are smarter than me swear it wasn't money printing, even though I'm pretty sure it was money printing. It finally is turning back up. When it breaks resistance, all hell breaks loose. You know, Grumps, we're going to look at the NFCI in a little bit here. It turned up very gradually in this most recent reading, but if you look, it is still clearly in a downtrend. And, you know, we're talking about well below zero in the negative territory. So financial conditions are far from tight. Even at the peak of the tightening cycle, we were still in negative territory. Financial conditions never went positive, i.e. tight, not once during this whole tightening cycle from the Fed. And Midnight is going crazy again here. Hey, buddy, he's going to be attacking my feet in no time. What's going on, big guy? Yeah, you making that face at me. You're blowing up the live stream again, Midnight. God, man, my kitty, man, he's just all up on my feet. He's got this. There's Midnight. He's got this thing. He likes to attack my feet while I'm live streaming. He's playing. He wants me to rub his belly with my feet, but it's kind of hard to keep my train of thought and keep doing what I'm doing. But there's my lazy cat with his belly out and everything. You need to get a job, Midnight. You got to start pulling your own weight around here. Thank you so much, Grandpa, for the super chat and for the support of the channel, sir. You are a gentleman and a scholar, and very astute observation about financial conditions as well, Grumps. Thank you, sir. And Jana Williams, thank you so much for supporting the channel with that super sticker that doesn't show up on StreamYard, but it is a number 10. Are you saying I'm number 10? All right. Who are these 9 above me? I must know, and I must strive to surpass them. I jest. Thank you so much, Jana Williams. I appreciate the super sticker and the support of the channel. Now, let's talk more about the shiny. Let's talk about gold, shall we? I like the shiny. Look at this chart. Look at that big, beautiful green candle. We're looking at daily candles here, guys. This is going back to the end of last year here. And you can see pretty much at the start, about the end of February, gold really rocketed. We traded sideways for a while. Then we made a new all-time high. We had a little bit of a sell-off and bounced around. And then look today, and I'll be honest with you guys, I don't know specifically what it was today that led to this surge of buying in gold. Again, take your pick. All those reasons we talked about in the opening monologue, the lower rates, the weaker dollar, the presidential politics becoming a clown show, the central banks being spineless, the recession risk across the globe. Any one of those could be driving gold prices higher here. But we are seeing a big move here, almost 2% higher. And I just love that 25 handle. Been waiting for that for a while. Next stop, 3,000. I don't care if I'm getting ahead of myself. It's long overdue. We should have been here for a long time. So let's see. What's the mainstream saying about the gold price here? Let's check in with Reuters. This is from today. They're saying gold rallies to record high on softer dollar and rate cut expectations. All right. Hey, midnight. I'm talking here, buddy. I'm speaking midnight. What do you want, buddy? You want more food? I fed you twice today. The fat cat needs to get a job, man. All right. Let's see. Gold prices soared to an all-time high on Friday as the dollar weakened on growing expectations for an interest rate cut from the Federal Reserve in September and as tensions in the Middle East bolstered demand for bullion. So we got a little bit of geopolitical tensions going on there. My buddy John Galt from Macro Edge, he was speculating that, hey, maybe there's something going on beneath the surface geopolitically that's got people buying gold. Maybe, I don't know, maybe did the Iranians telegraph another missile strike or something? Take your pick. I mean, my opinion is there's enough going on above the surface in the geopolitical realm that we don't need any of that subsurface stuff to drive gold prices higher. But maybe there's something going on in the Middle East, entirely plausible. Spot gold was up 1.3%, now 2% higher after hitting a record high of 2,500 earlier. We're going to have to update that number. This is a 2,504, I think, is what we saw a few minutes ago. U.S. gold futures rose. Bullion has risen 2.4% this week. The dollar index fell 0.3% and was on track for a fourth week of losses, making gold more appealing for buyers overseas. Gold surged to a fresh all-time high and breached $2,500 after 2 weeks of extremely choppy trading as bulls finally imposed their will, said Tai Wang, a New York-based independent metals trader. Tai Wang, I love your language here. The bulls have imposed their will. I love it. I'm the emperor of the People's Republic of Jakistan is ruling with an iron fist. Yes, gold shall go higher. I have decreed. I have imposed my will. Don't worry, I will be a gentle and kind dictator, says every dictator ever. Attention will now shift to focus on Jackson Hole and Fed Chair Powell's speech a week from today to provide more detailed outlook on the shape of upcoming rate cuts. You know what? Sometimes I just wish the Fed would shut their Jackson Hole. I'm going to go ahead and throw it. Shut your Jackson Hole, Fed. We don't need any more speeches. We don't need any more posturing. We don't need any more discussions about inflation is moving sustainably towards our arbitrary 2% target, and it may be appropriate for rates to remain restrictive for some time. We know what he's going to say is the same thing he always says. Anyways, those September rate cuts, guys, they are basically baked in now. They're going to happen. Like just checking in at CME futures here, 74.5% chance of a 25 basis point rate hike in September with an outside chance 25% of a 50 basis point cut. I don't think that 50 basis point cut is going to happen. The Fed would be losing face. I think at least one 25 basis point cut. Maybe they go 50 in November if things deteriorate, maybe not. But I think 25 is probably happening. And fast forward to December, it looks like right now the market is saying 50 to 75 basis points of cuts through the remainder of this year. So it looks like 2, maybe 3 rate cuts before the end of the year is probably what's going to happen. Now, let's talk about some other things like, say, the U.S. 10-year yield. All right, and this has been moving higher for the last couple of weeks. So maybe this is why gold has been running here, right? We've got a pretty big drop in the 10-year yield. And then, of course, we took a dive on that Japan panic. We bounced a little bit higher, but if you zoom in over the last 4 or 5 days here, 10-year yield is negative for this week. So yields have been dropping a little bit. Lower yields is bullish gold prices, right? Gold competes with bonds for safe haven asset status. And while gold doesn't yield anything, gold actually has a slight ownership cost. You need to store it and protect it. And so when interest rates fall, gold becomes more attractive than bonds, or at least it becomes slightly less unattractive because of the carrying cost. And so it's possible these lower yields are contributing here. Now, it's also important to keep in mind what's been going on with gold. And I want to send a shout out to my buddy Joe Brown. This is actually a screen grab from one of Joe Brown's videos that he did about stealth QE. And I showed this during my interview with Joe Brown about 2 weeks ago, which was a great interview, by the way. Now, this is showing the Fed's balance sheet. Forget the colors for a second. The top level, that is the Fed's balance sheet, right? So the vid happens right here. And we saw this big surge in the Fed's balance sheet, and then they kept growing it. They kept doing QE, and then they started QT, and the Fed's balance sheet has been slowly falling since the beginning of 2022. But the important thing to notice now that we've seen what the absolute level of total holdings of the Fed balance sheet has been, now let's talk about the long duration stuff, because you see the color code is broken up by the maturity of that government debt. The red and the green, that's your short-dated stuff like your T-bills, all right, stuff that's 1 to 5 years, that's shown in orange. Now, most of the reduction in the holdings of these government bonds and government bills have been in the green, the purple, the orange, and the blue, which is basically maturities of 10 years or less. All right, the shorter duration stuff the Fed has been selling. But look at this bottom level here. Look at the yellow. That is debt that is maturing 10, 20, and 30 years from now. So that number has actually been growing this entire time. And again, this is not my chart. This is Joe Brown's chart at Heresy Financial. Highly recommend that channel. Joe's one of the best in YouTube. While the Fed has been telling us they're tightening, as far as the long end of the yield curve is concerned, the Fed is still doing QE. They're still net buyers. They're selling the short end stuff, but they're buying the long end, which means they're forcing the short end of the yield curve higher and they're forcing down the long end of the yield curve. I should do it this way because it's mirror image. So the Fed has been intentionally inverting their own yield curve. Why? I don't know. But they have been suppressing interest rates on the long end of the yield curve. So that tells me interest rates for the 10-year, the 20-year, the 30-year should be a lot higher than they actually are right now. The Fed is doing stealth QE on the long end of the yield curve. And let's also not forget about this one, the debt buyback program set to improve liquidity, says U.S. Treasury official. The U.S. Treasury, they're selling short-dated and they're buying the long-dated stuff. They're selling T-bills that mature in a month or 2 months, 4 months, 6 months, and they're using that to buy back the 10, the 20, and the 30. So what are they doing? They're suppressing the interest rates at the long end of the curve, and they're driving them higher in the short end. The Treasury is doing it too. The Fed and the Treasury are both doing the same thing, suppressing long-term interest rates. And what are they telling us? They're saying the first buyback took place last week. And while the Treasury expects to hold weekly purchases with caps that in coming months will go up to $30 billion a quarter, the outcome of operations will depend on price set for us. So the Treasury is bidding up the price of long-duration government bonds. And that, here we go, Grandpa, that is what leads us to this chart, the Chicago's Fed's National Financial Conditions Index. And this chart is telling, this is one reason why I actually think gold prices are rallying here. I think this is one reason why inflation is taking so long to come down, because the Fed has been telling us all along that they've been tightening, right? They called it the most aggressive tightening campaign in years, or whatever you want to talk. How often has Jerome Powell told us it may be appropriate for rates to remain in restrictive territory for longer than anticipated until the goal reaches sustainably, right? All that mumbo jumbo, all those live streams of Fed press conferences and all those speeches we listened to where Jerome Powell told us that they were tightening. Look at this chart. This whole time, not since 2022, not this whole time, have financial conditions ever gone into positive territory. And by the way, positive territory means tighter than average financial conditions. They have been looser than average this entire time. Now, the Chicago Fed National Financial Conditions Index, this is a more total, holistic view of financial conditions. It's not just the Fed funds rate. It's also bank lending. It's also what's going on in money markets. This also includes bank credit. And you can see, guys, we never once went into tight, restrictive territory. Not at all. Not since the beginning of this tightening cycle. We very briefly were in restrictive territory during the initial panic during the vid, when people were just selling everything and running to cash because they were terrified. Of course, the Fed put the kibosh on that with their liquidity bazooka. But look, guys, even through this whole tightening cycle, I mean, financial conditions went from negative 0.69 to negative 0.09. Never even went positive. And look, while we've been talking this whole time, and Grandpa mentioned it, it was right at the Silicon Valley and Signature Bank crisis, right at the banking crisis in March of last year, is when the National Financial Conditions Index stopped going up. You could argue it stopped going up before that in October of 2022. By the way, October of 2022, that was the gilt market freaking out over in the UK when they had their pension crisis and interest rates started exploding higher in the UK. And the Bank of England started immediately doing QE. Like within an hour, they started printing money and buying up bonds. Again, central banks have shown us how spineless they are. The second a little bit of pain appears in the market, They instantly turned the money printers back on. The UK did it in October of 2022. The Fed did it in March of 2023. And the Bank of Japan did it in August of 2024, just a few days ago. Central banks in the world's biggest economies are showing us what unbelievable sissies they are. I didn't want to say the word. I want to say. Mom puts up with a couple of, I can say shit every now and then, and Mom won't scream at me. If I drop a P-bomb, she's probably going to scream at me. But what a bunch of they are over at the Federal Reserve and the Bank of England and the Bank of Japan. The second things got hard, they started easing again. So they're already telling us what's going to happen during the next liquidity crisis. They're going to start printing and they're going to start lowering. And maybe that's why gold is surging here. And Grandpa, you nailed it with your comment, brother. Thanks again for the support of the channel. It was right at that March banking crisis where financial conditions started to ease, and they are still easing. They have continued easing all through last year as the stock market grinds higher, as asset prices continue to go higher. You want to know why the market keeps going higher? Because somebody is pumping liquidity into the system. Financial conditions are easing. The Treasury and the Fed are both doing it. That's why. It is not real. It's just a function of liquidity. It's just a function of the games the central banks and the treasuries and the finance ministries are playing. You can tell yourself whatever you want about large language models and generative AI and inferences and use all kinds of big words. It's just liquidity, guys. It's just the easy money. Now, Grandpa mentioned that we're turning higher here. I think if we zoom way, way in, yeah, we have turned a little bit higher with these most recent readings, Grandpa, but I would want to see this significantly higher before I say we've turned a corner, especially with rate cuts on the horizon. Now, we did get a little bit higher in this reading from August 9th. When was the freak out in Japan? Yeah, that includes the freak out from Japan. So I think financial conditions tightened with that August 9th reading because of that partial unwind of the carry trade that we saw 2 weeks ago. But that has now reversed, and I think we're probably going to see this chart resuming even lower from here. But that was a very astute observation about the NFCI, Grandpa. Thank you very much, sir, again, for the support of the channel. And thank you to Dan Hadeen. Excuse me, guys. We're almost done with that sore throat here. Thank you, Dan, for the super chat, sir. Towards the midnight cam. Oh, you want a kitty cam? You want me to put a camera on midnight? Been a while since gold has not been beat down at the end of the week. Yeah, it is interesting. And isn't today options expiration in the futures market too? Usually you get Mr. Slammy in control during the options beatdown. And you know what? Speaking of this, Dan, while we're here, I want to take a look. Oh, man, this is killing me. I want to take a look at the Commitment of Traders report, which should have just come out while I was talking. Oh, what is this? Come on. Don't make me spell commitment. I can't spell commitment. There we go. Commitment of Traders report. There it is. We should have our new CFTC Commitment of Traders report for metals and other, as of August 13th, we do, because managed money and other reportables had been massively long gold and silver. So I was a little bit surprised to see this rally. Let's see, have they reduced their long positions? They did. That's interesting. Now, this data is as of Wednesday. So we did see a little bit of capitulation. Managed money showing here's managed money showing their long positions. Managed money long, they were 35,805 contracts. That's down by 732 contracts from last week. They also increased their short positioning by about 308. So managed money is still way offsides long here. Like you can see here, the size of the long positioning is almost triple the size of the short positioning. And other reportables, it's even worse. You got 25,000 net long versus 3,700 or so short. Although the longs are down by 2,000. So you've had a little bit of capitulation here, but not much. If you're looking for an explanation of why gold is rallying, the Commitment of Traders report is no help whatsoever today. I was kind of hoping it would show me something, but it didn't. But managed money was pretty far into the long end there. And that tells me that there could be a price slam in the future. So be aware of that, guys. Anytime other reportables and managed money are so offsides long, that means the swap dealers, the banks could step in with a price slam and force them to liquidate and cause a cascade of selling. So conditions are ripe for a price slam. I just want to point that out based on what's going on in the COT report. Thanks again, Dan Hadeen, for the donation to the Midnight Cam. What do you think, Midnight? You want to be a superstar, buddy? Oh, please don't get up. Stay, please, by all means. Stay there with your belly hanging out. That's my boy. That's Midnight. Oh, all right. He's a good guy. Midnight's all right. Now, let's talk about silver, shall we? Because silver, what do we say about silver? All right, so again, daily candles, we're going back to about the start of the year here. First thing, silver is participating today. It's right here, right about the high of the day, $28.95, threatening to retake $29. I like that. We're also back above this red line. That red line, that is the high from the silver squeeze. If we zoom way, way out here, right, that's the closing high from silver squeeze. So I'd like to see us back above that level. That's acted as resistance before. You'll notice we closed right on it yesterday. Back above that one today. So happy to see that. Now, that being said, silver is still below the 50-day moving average here, shown in blue. Nowhere near an all-time high. I mean, if you want to talk all-time highs in silver, we got to go to 1 month here. We got to zoom way out. I mean, all-time highs for silver, we're talking almost $50 here, guys, just over $50. So we're just nowhere near an all-time high for silver. Let's get off of these monthly candles, shall we? I don't like those. Back on to 1 day. And I don't know what happened. I upset the trading view gods. There we go. So silver's looking better here, but it's still got a long way to go, and it is way, way lagging gold as far as year-to-date performance. Gold is way outperforming silver. Now, what's the difference between gold and silver? Gold is almost exclusively a monetary metal, and silver is 50-50 pretty much. It's might be a little bit more, but basically 50-50 for the sake of argument, 50% monetary metal and 50% industrial metals. Silver is used for its electrical conductivity. It's used for switch contacts. It is used in solar panels and batteries and missiles, and anything electronic has some silver in it. And unfortunately, I think it's the industrial element that's really holding back silver prices here. And we got some reports this week that I wanted to talk about that I think might shed some light on why silver is underperforming here. Let's talk about the Philly Fed Manufacturing Index. I got a super chat about this on my morning live stream yesterday, but we never got to it because there were so many earnings reports to go through yesterday. I just couldn't get to this in time. But there was some good information in here. The Philly Fed Manufacturing Index in the U.S. plummeted to -7 in August of 2024, down from a 3-month high of 13.9 in July and far below forecasts of 7. Now, for the Philly Fed Index, anything in negative territory is contraction. Anything above 0 is expansion. So Philly Fed Manufacturing went back to a negative here. That marks the first contraction since January. So if you look at the chart here, we had 6 positive numbers in a row. So we actually had a little bit of manufacturing expansion. Emphasis a little bit, because if you look at a 5-year chart, this has been negative pretty much since the tightening cycle started. But back to a 1-year chart here, this is the first negative read in 6 months for the Philly Fed. The report indicated an overall decline in manufacturing activity with slower growth in shipments, 8.5 versus 27.8. That's a big drop in shipments. New orders reduced to 14.6, down from 20.7. Employment turned negative. Pay attention to that. Recession, people, negative 5.7 versus 15.2. So we've had some job losses in manufacturing in the Philadelphia area. Meanwhile, both price indexes showed continued price increases. Inflation is not fully vanquished, with prices paid rising faster than before, 24 versus 19.8, while prices received also rose, but they slowed, 13.7 versus 24.2. So that's interesting here, guys. You're seeing a bigger increase in prices paid versus prices received. That's showing profit margins getting squeezed. And we've seen that in a lot of the S&P 500 companies, especially a lot of those consumer discretionary companies that have been reporting earnings. We're seeing much tighter profit margins because the manufacturers, the producers, they've lost pricing power. They can no longer pass on the price of inflation to the consumer because the consumer's broke and he can't afford it. And so if they raise prices, they're losing market share. Pay attention to all you imbeciles out there advocating for price controls. You communist schmucks. Price controls don't work. I said it this morning. I'm going to say it again. Price controls don't work ever. Repeat after me. Put it in the comments so people hear it. Price controls do not work. That being said, additionally, most future activity indicators slowed, signaling broader expectations for an overall decline over the next 6 months. So Philly Fed Manufacturing Index showing some signs of trouble here. Declines in employment, slowing growth in orders, slowing shipments. employment turning negative, prices paid going up faster than prices received, indicating contracting margins. This was a pretty bad manufacturing report for the Philly Fed. Now, yesterday on the same day, we got the Empire State Manufacturing Index, and it was a very similar reading. The Empire State Manufacturing Index increased to negative 4.7, so it went up, but it's still negative. The highest in 6 months compared to a negative 6.6 in July and forecasts of negative 6. It's basically within band. The reading showed business activity in the New York State edged only slightly lower, with new orders falling modestly, negative 7.9 versus negative 0.6, while shipments held steady at 0.3 versus 3.9. Delivery times continued to shorten, negative 3.2 versus negative 9.2. Inventories moved lower for the second consecutive month. Meanwhile, labor market conditions remain weak with a small decline in employment, negative 6.7 versus negative 7.9, so more people losing manufacturing jobs. A sharp drop in hours worked. That's kind of alarming, negative 17.8. You drop hours before you cut people. When you see the hours worked being cut, that is business owners. They're trying to retain their people. They don't want to have to train a replacement next year if conditions improve. So they start cutting back the hours first, but you can only cut back hours so much. Sooner or later, you start trimming headcount. And so this is telegraphing higher unemployment in the future here. On the price front, input prices increased at a slightly slower pace, 23.4 versus 26.5. So input prices still going up, while selling price increases remain steady and small, 8.5 versus 6.1. So that's interesting. Again, input prices rising faster than prices received, profit margins continuing to be compressed. And of course, that's resulting in fewer hours and fewer employment. But I would add that firms were fairly optimistic that conditions would improve in the months ahead, 22.9 versus 25.8. Now, look, the Empire Manufacturing Index has been negative pretty much forever. I mean, take this back 5 years. This thing has been below zero other than a couple of isolated incidences pretty much for the last 3 years. So I think these reports, these manufacturing indexes kind of give you a little bit of a hint at why silver is lagging gold, why gold might be at an all-time high as shown on this chart. Yay, gold. But silver is still lagging behind here, not making an all-time high. I think it's that slowing industrial output. And we're also seeing slowing industrial activity over in China. I'm not going to bring the article up, but we talked about this on the live stream a few days ago. China's steel industry is in big trouble, right? I mean, they're still making steel like gangbusters over there, but they're just making it and leaving it to rust in the yard. They're not selling it. The Chinese are subsidizing their steel industry because there's no building going on in China anymore. And so China has started dumping their steel inventory on the global market, suppressing steel prices because they just don't want to slow down their manufacturing. The government subsidizes it. But when you're no longer building entire cities that nobody needs, well, your steel prices are going to start falling. And it's also going to take down your copper prices because you're not going to need things like wiring. You're not going to need things like piping if you're no longer building cities that nobody wants to live in or nobody even is going to buy the apartments. Why were they building those towers? I don't know. Just growth at any cost. But the copper prices are going to start falling as well. And hey, guess what, guys? Most silver actually comes out of copper mines. So I've been mentioning this for a couple of years. I do think the collapse of the construction industry in China is eventually going to lead to a major supply deficit for silver because silver comes from copper mines and silver comes from lead and zinc mines, all things that we're going to need a lot less of because of the slowdown in China. And I think it will take significantly higher silver prices to get any kind of new supply to hit the market, because very little silver actually comes from silver mines. Most of it comes from those copper and those lead and zinc mines. But for now, the Chinese are still subsidizing those industries, so the stuff is still coming out of the ground. So I guess we're going to have to wait for that supply deficit. Also going on today, guys, we got the Michigan Consumer Sentiment Index was just released, and it was a slight improvement, but not very much. The University of Michigan Consumer Sentiment for the U.S. rose to 67.8 in August of 2024. That's up from 66.4 in July and above forecast of 66.9, basically flat, noise in the chart. It marks the first increase in 5 months. Overall expectations strengthened for both personal finances and the 5-year economic outlook, which reached its highest reading in 4 years. So here's the Michigan consumer sentiment. Look, it's been falling for the last couple of months. It's leveled off. Now it's up a little bit, pretty much where it's been for the last 4 months here. I wouldn't read too much into this. Slightly better conditions in Michigan. Okay, that's good. We did see those retail sales numbers came in higher than expected for the month of July. So maybe we're seeing a little bit of that reflected in the Michigan Consumer Sentiment Index. Maybe there's a there, but I need more data before I fall in line behind that. But the other thing to keep in mind, especially when we're talking about the consumer, guys, is the unemployment situation and more anecdata about unemployments. This one is a day or two old here. Paramount TV studios shutting down amid major restructuring layoffs. Look, I don't normally cheer somebody losing their job unless it's a politician getting fired. But Hollywood, bye-bye. Make something somebody wants to watch for a change, and then maybe this won't happen. That being said, more people losing their job, not a good situation. Paramount Global shutting down its namesake TV studio as the company embarks on a major round of layoffs. Paramount TV studios will cease operations at the end of the week. Guys, they've been running for 80 years? This studio has been in operation. This is a big deal here. President Nicole Clemens and Paramount co-CEO George Cheeks told staff on Tuesday morning, by the way, danger, danger. Anytime you see co-CEO, run, do not walk for the exits. Nothing good ever came from a co-CEO. Clemens will exit the company and all current TV series and projects in development at Paramount TV Studios, including Reacher, Apple's Time Bandits, and the upcoming Cross at Prime Video, will move under the CBS Studios umbrella. Paramount announced last week that it would lay off 15% of its U.S. employees on top of about 800 layoffs 6 months ago as part of an effort to save $500 million in costs ahead of a planned merger with Skydance. Cheeks and fellow CEOs Brian Robbins and Chris McCarthy told staff earlier Tuesday that layoffs would begin that day and take place in 3 phases over the remainder of the year. Wait a minute. They're saying Cheeks said fellow CEOs, Robbins and McCarthy. They have 3 CEOs? How many CEOs? How many captains can you have on one ship? 3 CEOs at Paramount TV Studios, and then wonder why they're going out of business. Co-CEO, major red flag, guys. Danger. Run, do not walk for the exits. Thank you very much to MVD Reports. I like that. He says, NSF t-shirts, price controls don't work. Go, go, go. Not a bad idea. All right. Price controls don't work. I don't know, man. That sounds like a little bit too much of a chick magnet. You show up at a bar in a t-shirt that says price controls don't work, and you're going to be fighting the ladies off with a stick, or so I'm told. No? Why is everybody laughing? That was not a laugh line. I feel like the Stephen Colbert talking about CNN and their unbiased, pragmatic coverage. That wasn't a laugh line. Why is everybody laughing about my chick magnet price controls don't work t-shirt? Hey, that's hurtful, guys. Thank you, MVD Reports. I appreciate that. And that's not a bad idea, guys. I don't know. You want to see a price controls don't work t-shirt? Let me know in the comments. Ask and ye shall receive. Thanks again, MVD. Appreciate that. Oh, and he's back. MVD Reports is back again. MacroEdge just said MasterCard layoffs. Yesterday was SoCal Northrop, recession, let's ride. First of all, thank you so much, MVD, again, for supporting the channel and for the shout out of MacroEdge. MacroEdge is freaking top notch. Let me just tell you, I've been getting to know those guys over the last couple of months and weeks. They are sharp over there and they catch everything. And their layoff tracker over at MacroEdge is excellent. It's, as far as I can tell, if you're trying to track job losses, it is the best real-time data point available. So I highly recommend MacroEdge. They're at MacroEdge RES on Twitter. I've been following them. Good bunch of guys, very smart. And yes, I did catch the MacroEdge post about MasterCard. I don't believe I have an article up about it. The one thing I did notice about the MasterCard layoffs, I think it was something like 3% of their global workforce, and it was going to be somewhere around 800 people, and it was global. So like 65% of MasterCard's workforce is outside the United States. So it was going to be a few hundred U.S. layoffs. It wasn't going to be a needle mover as far as unemployment goes, but it is another drop in that bucket that is getting a lot of drops lately. There's a lot of leaks in the ceiling and that unemployment number. You can add MasterCard to the laundry list of layoffs we've been talking about over these last couple of days. So thank you very much, MVD. I appreciate that very much. And thanks again to MacroEdge for the excellent job you guys do tracking layoffs in the economy And the inflation situation, what's going on, brother? He says highest weekly close for GDX since April of 2022. Interesting. All right, let's bring that one up, shall we? Let's take a look here. Let's bring up GDX. Guys, if you don't know GDX, that is the gold miners ETF run by Van Eck. I haven't covered the miners very much. You're right. You know what? Let's not use Yahoo Finance. Let's use TradingView, shall we? Let's bring up GDX on TradingView here. Gold miners ETF from Van Eck. Daily candles, highest close since, is this accurate? 1 day candles. It looks like we were higher on Tuesday. Anyway, highest weekly closed. Is that where it was? Yes, highest weekly close. Devil's in the details. All right. You're still alive here, the inflation situation. Let's see. Was it the highest? Highest weekly close since April of 2022. And he's right. Congratulations to the inflation situation. Excellent. Almost had to call a chart time on you there, brother. But you are right, sir. Highest weekly close since April of 2022. And before that, well, look, guys, here's the funny thing about this chart. And this kind of reminds me of the silver chart here. When was that? Was like January, February of 21. So let's just put a line here. Let's put a line at the all-time high for GDX. Even though gold is at an all-time high here, that's not quite a horizontal line. You can kind of see, guys, the miners have sat out this rally. Yes, the miners are up. They've had a good couple of months here. They're definitely up year to date. But if you look at where we're at, nowhere near an all-time high. I mean, we still got a long ways to go to hit an all-time high for the miners. So I would say the miners are yet to confirm this move in metals. Something is going on in the miners. Maybe it's the labor cost. Maybe it's the fuel cost. They're just not able to cash in on this. And let me just also say, be very careful in the junior mining space, guys. There are so many snake oil salesmen in the junior mining space. Be very careful before you buy into one of these survey result reports and start piling into the stock. Most of these guys, or a lot of these guys in the junior mining space, they're very good stock salesmen. They are not very good at digging gold out of the ground. Not most of, some of them, I'll say. And it's very hard to tell them apart. So always look up the history of these guys. If you're looking at getting into a junior miner or something like that, look up the name of the CEOs and the big investors and look at what their track record is in their other companies. I've been approached by mining CEOs who wanted to pay me to do interviews, and I go and look at their history, and like these guys have sued their prior companies. Like they sued their own shareholders to recover as much money as they can for themselves, and all the people who bought their stock got wiped out. So there's a lot of snake oil salesmen in the mining industry business. Be very careful, guys. That being said, miners, two ways you could look at this. Either the miners have not confirmed the move in the underlying metal, or because of the move in the underlying metal, the miners are primed and that spring is coiled and they should be going much higher from here. Let me know in the comments what you think, guys. Right now, I own a couple of miners. I've been holding them for a few years, but I don't really trade mining stocks that much. So I haven't really been paying attention to this one. I would much rather just watch the underlying myself, to be honest with you. It's very speculative in the mining space. But thank you very much to the inflation situation, sir. And good call on that chart. And Viv B, thank you so much for being a Melonhead member for 5 months. Insert random Yellen impression here. Do you really, I don't have the image up here in front of me, but if I had it prepared and you wanted me to do my random Janet Yellen impression, I'd probably say something about those buybacks, but pay no attention to the fact that I am further driving your government insolvent just to make my boss look a little better so I can hopefully keep my job for a few more years and then collect additional funds for myself in the form of speaking fees after I leave this post. And then all of a sudden Goldman Sachs wants to pay me $4 million for a 15-minute speech to their junior executives. Are they getting millions of dollars in value from me? No, it's obviously payment for services rendered while I was in office. Wow, Janet, an unusual spout of honesty from a politician there. Janet, I didn't know. Wow, I mean, I'm blown away here. You're spilling your guts to me. Thank you for that candid moment, Secretary Yellen. I feel like we've really grown personally here. Thank you very much, Viv B, for the super chat and the support of the channel and for being a member, a Melonhead member for 5 months. Thank you so much, Viv B. All right, guys, the markets are closed. Let's see where we finished the week at. The S&P ended up closing at Oh, no. Still looking at the futures. Chart crime, personal foul, chart crime, melonhead, repeat fourth down. Come on, and we got to get rid of the pop-up. All right, the S&P closed at $5,550.15. My, that's a lot of fives, up almost 12 points or 0.22%. So it ended up being a pretty good week for the S&P. Again, the rally is back on midnight. I'm almost done, buddy, and I've already fed you twice. You're going to have to back off me, big guy. Also, the Dow ended up closing the week at 40,659, up 96 points, just off the highs of the day to close. And the NASDAQ closing at 17,631, up 37 points, also just off the high of the day, but still up. Positive week for stocks, guys. But you know what? That is not the story of the day. The story of the day is gold, finishing the week at 25.08. I love it. Look at gold go. Keep it going. More of that, please. So congratulations to the stackers. And look, guys, if you want to know, like, specifically what is driving this gold rally, again, I couldn't put my finger on what specifically it is. Maybe there's going to be some geopolitical event that the banks found out before anybody else. I mean, it's not like wars are scheduled and pre-planned in advance or anything, and that the big guys know to position themselves before anybody else, right? Oh, that does happen? Wow, that's dark. Maybe that's going on. Or maybe it's just the lower rates and the weaker dollar. Or maybe it's the spineless central banks who have shown us once again their true colors, as Grandpa pointed out during the banking crisis, or as the Bank of England showed us in October of 2022 with the gilt market crisis, or as the Bank of Japan showed us just a few days ago when they eased off their pathetically small rate hikes because the market freaked out at a measly 25 basis point interest rate. Any one of those things is enough to drive gold prices higher. Or maybe it's everyone gets a pony in presidential politics and the economic illiteracy of the general public at large, because people are actually buying this crap. You would think after stimmies and after inflation, people are realizing when the government offers you something for free, they're robbing you. They're stealing from you. We still haven't figured this out. How bad does inflation have to get before people realize when the government offers you free shit, they're robbing you? Anybody? I can't be the only one here. I know you guys know that. Maybe that's why gold is rallying. Take your pick, guys. Gold is going up for good reason. Let's not stand in its way. Let's let it. And again, to you silver stackers, you guys have been patient. Your time will come. But that industrial output or that industrial demand for silver, that's going to hold back the shiny in the meantime. But you know what? That also means it's on sale. And so if you want to pre-position for a recovery in manufacturing and industrial activity, whenever that may happen, then silver is a good deal at these levels. Anyways, guys, take your pick. That's all I got for today. I want to say thank you so much for ending the week with us here for the weekly wrap-up. Congratulations again to the stackers. Thank you, everybody, for the super chats and the support of the channel. I appreciate that so much. Also, thank you to all my channel members and magnanimous melon heads on YouTube and Patreon. You guys rock. Links down below to all that good stuff, should you feel so inclined. Hi, Mom. Hi, Dad. I love you guys. Everybody have an awesome weekend. I'll see you Monday. Till next time, live small and dream big.